Welcome to the Module 3 of the Open Learning course, a primer on Retail Central Bank Digital Currency. I am Srichander Ramaswamy, Director, Financial Stability, Supervision and Payments. This is the last in the series of modules on Retail CBDC. After completing this module, you will have a good foundational knowledge that will help you actively engage in the debates on the pros and cons, design choices, and the use cases of Retail CBDC. The first slide is the usual disclaimer that the views I express do not necessarily represent the views of the SEACEN Centre or its member central banks. That cleared, let me move on to the Module 3, which covers the topic, does Retail CBDC have a use case? Some may wonder, if Retail CBDC does not have a use case, why are so many central banks pursuing this project? You may recall that I mentioned in my first module that many central banks are working on this project under the learn but not launch motto. Clearly, there is reason to believe that they may want to assess and understand the clear and unambiguous use cases that a retail CBDC offers to the existing fiat currency monetary system, while private digital currencies continue to proliferate. This module can be seen as providing some input on the policy questions that central banks might be trying to address. Before I proceed to give an outline of what will be covered in this module, let me quickly recap what we covered under Module 2. Module 2 discussed different design choices when introducing a retail CBDC, and I said that a two-tiered architecture with financial institutions hosting the CBDC account that pays no interest with a cap enforced on holdings is a preferred option. I discussed that conducting monetary policy and maintaining financial stability can be major challenges if no caps on the CBDC holdings are imposed. Now, turning to Module 3, the following topics will be covered. Motivation for retail CBDC issuance. Under this, I will cover the decline of cash in circulation, the rise of private digital currencies in payments, and the loss of monetary sovereignty. I will then briefly discuss the demand for retail CBDC in countries that have introduced this. There has been some talk on the role of CBDC in financial inclusion and faster payment settlements. I will provide some thoughts on this. Next, I will examine what role retail CBDC might play in money creation and funding economic activity. Can retail CBDCs compete with private digital currencies? That's $1 million question, but I will share my thoughts on that one. On the last slide, I will give my concluding remarks. Let me now turn to a much debated topic, namely the concern in some quarters that cash in circulation is on the decline. So, why is that a concern? Well, some argue that the loss of access to a central bank money, that is cash, for the public can lead to a loss of trust in the monetary system. This justifies the introduction of a retail CBDC. But Sina Krogstrup, governor Denmark's national bank, says that some are concerned that the disappearance of cash can undermine the trust in the monetary system. However, It remains to be seen if cash in the hands of the private citizens is the anchor of trust in our current monetary system. Why does she express this doubt on the assumption that trust in the monetary system will be undermined in a cashless society? Well, for that, you have to look to China and Sweden, where holding cash in the wallet is a rarity and may not buy you a sandwich or a drink in the kiosk. But this has not resulted in the trust in the monetary system disappearing. But is cash in circulation really declining everywhere? Perhaps it's declining in daily transaction, but not as a store of value. So turning to the next slide, here is a graph of cash in circulation as a share of GDP in a number of Asia Pacific countries. You can see that cash in circulation in many countries in the region as a share of GDP has actually increased over the period 2017 to 2023. So you cannot make the claim that cash in circulation is declining. The graph shows that cash in circulation as a share of GDP is still roughly about 8 to 15% across many of these countries. The box in the graph shows currency in circulation in the United States. This has been 1.3 trillion US dollars in 2013, and in 2024 it rose to 2.32 trillion dollars. As a share of GDP, cash in circulation is around 8% in the US. The next slide shows the share of different payment instruments aggregated across countries. I'm using here the payments data provided by the HKMA, the RBI, the Bank of Laos, BNM, Central Bank of Myanmar, Nepal Rashtra Bank, Central Bank of Sri Lanka, and Bank of Thailand. You can see on the left panel that the share of digital transactions by value has been rising constantly over the years. This is being driven by mobile and internet-based payments. The share of checks has been falling but remains high in terms of total value these transactions represent. This suggests that there is continued use of checks by many businesses in the region. The right-hand panel graph shows a similar picture. This captures more the small value payments, as the statistics is based on volume of transactions rather than the value of transactions. Again, you can see that the check payment has been on decline, whereas mobile and internet-based payments have been rising. It is useful to note here that in terms of volume of transactions, digital wallets and prepaid cards remain high, whereas in terms of values, they are still small. That is because the volume of transactions captures the small value retail payments, whereas the graph on the value of transactions is representative of the large value payments made by the corporate sector. Moving to the next slide, we will examine whether retail CBDC issuance can be motivated by its role in avoiding the loss of monetary sovereignty. Indeed, some central banks worry that the use of private digital currencies denominated, say, in the US dollar or euro could undermine the national currency and monetary sovereignty. This can happen if there is a large share of digital currency in a foreign currency in circulation, which can lead to the loss of effectiveness of the price and quantity channels of monetary transmission if goods and services in the country come to rely on crypto or other digital assets. Well, if that is a concern, one option will be to ban the use of private digital currencies denominated in a foreign currency. But It is important to ask here if the loss of monetary sovereignty is the absence of a retail CBDC. More important factors that determine monetary sovereignty and trust in the national currency are credible government fiscal policies and central bank independence. Even if we assume that a retail CBDC can help reduce the influence of private sector digital currencies, there must be a lot of retail CBDC in circulation. That, by implication, requires no cap on CBDC holdings, and there must be also a lot of retail investor demand for it. On the demand side, the table below shows currency in circulation and outstanding amounts of retail CBDC in India. The share of retail CBDC in currency in circulation is around 0.027%, which is negligible, implying that there is little demand for retail CBDC. So why is there little or no demand for the retail CBDC? I'm going to refer to what Ishwar Prasad, professor at Cornell University and author of the book The Future of Money, wrote in a Financial Times article. He wrote that retail CBDC demand is still scant and the case for them has weakened. The landscape looks less promising in practice than it did a couple of years ago. China, Brazil, and India are undertaking trials but face scant demand for the CBDCs as they already have excellent digital payment systems. And Sweden's Riksbank has concluded a multi-year pilot, but a parliamentary committee has found no pressing need for an e-krona project. Nigeria's e-naira has been a flop. I may add here that the ECB's retail CBDC project has been long and painful. On this slide, I will try to highlight some key takeaways from an IMF report on retail CBDCs. The report makes the observation that among the countries that have already launched CBDCs or are conducting large-scale pilots, adoption remains slow and limited. So what are the reasons for the lack of demand for retail CBDCs? The reasons cited for this include low adoption rates among the merchants with point-of-sale terminals, shortcomings in customer education, and banks and credit unions exhibiting slow engagement. Taking the example of Nigeria, it finds that about 98.5% of e-naira wallets were unused 1 year after its launch. In other words, almost all of the holders of e-naira did not find use cases for it and have left them unused. In China, where apps like Alipay and WeChat Pay dominate the payments landscape, ECNY constitutes only 0.16% of M0. Data privacy concerns are cited as a possible showstopper for greater adoption of ECNY. But my take on this is that ECNY, which is China's retail CBDC, cannot compete with an efficient and fast private sector payment ecosystem. In India, the widely used UPI app for payments has also been the contributing factor for a lack of demand for retail CBDC. The next slide raises the question whether the retail CBDC is a solution in search of a problem. That phrase was coined by the Fed Governor Chris Waller. Chris Waller starts with the mandate of the central bank, which is to fulfill a public role in maintaining monetary and financial stability and in fostering efficient payment systems and performing its oversight function. In delivering on this mandate, there is congressionally mandated division of functions between the Federal Reserve and commercial banks. That division of functions is meant to ensure that the Federal Reserve is not in direct competition with the private sector in areas of oversight and regulation. Any interventions made in these areas are only foreseen and justified when there is a market failure. In case central banks identify a market failure, their task after the initial firefighting phase is over should be to build proper regulatory guardrails if these failures suggest there are gaps in regulatory frameworks. According to Chris Waller, member of the Board of Governors of the Federal Reserve System, there are no specific market failures that have been identified that a CBDC is required to address. That leads him to conclude that CBDC is a solution in search of a problem. Let me turn to the next slide and examine the role retail CBDC can play in financial inclusion. Because financial inclusion is the gateway to increased prosperity, associating CBDC with financial inclusion is a good political use case story. But the bottlenecks to financial inclusion are complex. For example, if a retail CBDC design relies on traditional account-based monetary system, the CBDC cannot be accessed by the unbanked population. For them, the lack of a verifiable personal identification is a major hurdle to opening a bank account. Moreover, financial literacy is usually a precondition for financial inclusion, and a retail CBDC cannot address this. Further, for CBDC to increase financial inclusion, it must address the causes of exclusion, which vary by jurisdiction and are often complex. The use case of a CBDC as an enabler of financial inclusion is therefore on shaky grounds. The experiences with e-Naira, Sand Dollar, and India's RCBDC are suggesting that the financial inclusion story is a myth. Existing private sector payment solutions are better in addressing this. Let me now turn to the use case of retail CBDC as an enabling or promoting fast payments. When we look at the Asia Pacific region, most jurisdictions have already implemented fast retail payment systems. India's UPI, Malaysia's Do It Now, and Thailand's Prompt Pay are examples. One can conclude from this that a retail CBDC may not offer a better option for daily transactions in countries that already have efficient, fast, secure, and widely adopted digital payment systems. The next slide examines the role of the retail CBDC in money creation and funding economic activity. Recall that the retail CBDC is a central bank liability. Commercial banks cannot use this for money creation. But the central bank liabilities cannot also fund economic activity. The direct extension of loans to business and retail clients is not in the mandate of central banks. As I mentioned earlier, there is a clear division of responsibilities between central banks and commercial banks. Money creation, which leads to an increase in M1 and M2 to fund economic activity, is the role of commercial banks. Some NBFIs are now taking on this role too. For commercial banks to be able to do this, the money creation role, Retail and corporate clients will have to be willing to hold commercial bank liabilities in the form of demand deposits or saving deposits. If we prefer to hold them in retail CBDC, the money creation process will be disrupted. I also want to draw your attention to the fact that cash in circulation, excluding what commercial banks hold in vaults of central banks, also funds economic activity. In several emerging market economies, small businesses still rely on small value cash transactions and take loans from cash lenders. What will happen when cash in circulation declines or disappears? Note that cash to GDP ratio in Sweden fell from 3% in 2010 to below 1.3% now. In the United States, cash to GDP ratio is still around 8%. Now, if cash in circulation progressively disappears or declines, central banks may have to offset this fall in M0 by lowering cash reserve requirement to allow banks to increase money supply. Let me turn to the next slide, which raises the question whether retail CBDC can compete with private digital currencies. An IMF paper suggests that the retail CBDC could enhance trust in the financial system by providing reliable central bank-backed digital payment option and infrastructure settlement. But I have serious doubts that trust in the national currency and the financial system can be enhanced by introducing a retail CBDC. The trust should come from sound government fiscal policies and the central bank's ability to keep inflation under control, and that requires central bank independence. The adoption rates of retail CBDCs examined so far do not convincingly argue for the case that existing digital payment infrastructures lag behind. If the public has identified market gaps or inefficiencies in the existing commercial bank and private money-based payment options, there would have been broader adoption of retail CBDCs in the jurisdictions where they were introduced. One of the features of a digital currency, namely smart contracts, is being sold sometimes as a use case for the retail CBDC project. The belief is that the programmability features of a digital currency, which the retail CBDC represents, can be exploited to open the door for financial innovation. But that gets into the direct competition with tokenized deposits that banks are working on, which will provide similar or even enhanced features. As I said earlier, competition with the private sector is not in the mandate of central banks. And finally, tokenized deposits, which are direct commercial bank liabilities, can be used to fund economic activity, and they can be extended deposit insurance cover. Let me now conclude the primer on retail CBDCs. After exploring the potential use cases of a retail CBDC across different dimensions, we could not come up with convincing use case that will encourage retail investors to shift some of their bank deposits to a retail CBDC account. The absence of a good use case might be the reason for poor adoption rates of retail CBDCs worldwide. The existing digital payment solutions, such as QR code payments, mobile wallets, POS terminals, and online banking, are already playing a strong role in supporting financial inclusion and have a far greater reach than bank intermediated retail CBDC. For the public, the nuances between fiat currency based digital money and the central bank digital money will be difficult to understand. When the fiat currency digital money, say the tokenized deposit issued by a commercial bank, is covered by deposit insurance, there is little difference between this deposit and a retail CBDC deposit, as both enjoy the same level of protection. When caps on retail CBDC holdings are imposed and they accrue no interest, a design feature that is characteristic of existing retail CBDC projects, the use case for holding a retail CBDC account will be further diminished. It is fair to say that the needs of retail customers are being met today in an evolving, efficient, and interoperable payment ecosystem. If a retail CBDC is introduced in such an ecosystem, it will simply become another e-wallet for users in the best case scenario. That takes us to the conclusion of Fed Governor Chris Waller, where he sees no use cases for the retail CBDC. So, thank you for your attention, and I hope the 3 modules that were structured to provide a foundational knowledge of retail CBDC was helpful. It was my pleasure to share with you some of my personal views and highlight the key challenges facing the introduction and adoption of retail CBDCs.